Welcome back, future billionaires, to another episode of the Invest Like a Billionaire show. My name is Ellis Hammond, and I am joined today with Bob Fraser. Bob, how you doing?
Yeah, great to be here.
Hey, this is kind of a timely episode. We are meeting on Thursday, September 18th. Yesterday, of course, the Federal Reserve met and made a decision to cut rates for the first time in a long time by 25 basis points. Let's start there.
Yeah, I think the market expected it, and we're looking for maybe two more cuts this year, which would be pretty interesting. I think, the stock market reacted positively, and I think it's definitely a good thing for real estate investors. We've seen a lot of pressure in the commercial real estate sector, and there's been a lot of people just kind of collectively holding their breath to see if rates would come down. And they're definitely starting. So it's possibly the beginning of the next cycle in real estate.
Let me ask you a question, because I find that online and across the media, it's a divisive issue, which is interesting because, the Federal Reserve has a clear mandate, as its existence, right? They want to maximize employment. They want to keep inflation low. Why do you think this has become what almost feels like a political issue? We even saw Trump, hard to say if this was, him trying to get rid of a seat to get someone else in. Why does this feel so much, Bob, if there's a clear mandate from the Fed that this is a divisive issue politically?
Yeah, well, I think it is a divisive issue. And clearly, Trump is putting pressure on the Fed, which is a little bit unprecedented. And I think it worries a lot of investors. The Federal Reserve Bank has been independent since its inception 100 years ago. And so I think most investors want that. We want an independent Fed. I do. And I'm concerned, that it's the politicization of the Fed. So does that mean prior to every election cycle, we're going to see the Fed cut rates regardless of the damage in order to kind of boost the stock market and get election results? No one wants this. So we've had an independent Fed, and clearly Trump is wanting to see the economy get stronger, and he's trying to juice it. So I think there's a lot of concern, and I think anyone who, is against Trump on the political spectrum is against this, right? Because they're against everything that he wants to do. And I'm more neutral. I like the rate cuts. I do think they're risky. The Fed has not achieved its inflation goals, right? We're seeing the PCE running around 2.6% right now, and they have a stated goal to keep it at 2. So what are they doing lowering rates if they haven't made their goal yet? Now, you've been watching my forecast for years, and I've said inflation is going to be stickier than otherwise, and I think the 2% goal is going to be very, very elusive. There's several reasons for that, and I've been proven right so far. So is the Fed willing to endure higher inflation rates in order to keep us out of recession? And I think the recession indicators, there's no strong indicators of recession. We're seeing a little bit of softness in the job market, but it's not a lot. And the data is really suspect.
Yeah.
We're seeing huge revisions in there. So I think it looks a little bit like maybe the Fed is bowing the knee to Trump, possibly. But on the other hand, I've watched Powell for years, and he's as independent as they come. I think he's resisted the pressure, and I think he's a very middle-of-the-road guy. He's a Republican politically, but he has been on both sides of the aisle. He's nonpartisan. He doesn't favor any political party, and, I have a lot of respect for Powell. So I don't really think he's necessarily bowing the knee, but I can see why people would say it looks like that.
Well, let me ask you this, because you talked about your projections. Earlier this year, when Trump got elected, DOGE was a big thing, right? We were going to cut our way out of our deficit in terms of our national debt. And you said, and I remember you saying this, hey, I'm more surprised at how successful they've been so far, but I don't think it'll ever be enough. And I think you were absolutely proven true at this point that DOGE is kind of a nice idea at this point. But when you introduce a new bill, right, to increase it, by trillions of dollars, then what do we really do? Is it your interpretation that Trump's ultimate goal is to essentially try to grow our way out of our national debt?
I haven't seen anything coming out of Trump where he's concerned about the national debt. Okay. So I think he's more concerned with the stock market and with economic growth. So I think the thing that he measures his success by, economically speaking, at least, would be GDP growth and or stock market growth. Very few politicians are talking about the deficit or the national debt, because it hasn't really been a problem yet. And so it's not going to probably be addressed until it really becomes a problem. Now, and in my view, it's starting to rear its head, right? We're seeing the early little yellow flags, right, where the bond market auctions have been weak. Now, recently, of course, they've been on fire again. So who knows, it's like we see a little bit of a red flag and then red flag disappears. So, but at some point, debt is going to be a problem. And by the way, the solution to the national debt, and I've said this before many, many times, is a little known reality called inflation. One of my favorite authors are Ken Rogoff and Carmen Reinhart, who wrote a book called This Time is Different years ago. And they studied 800 years of financial crises in 65 countries, over 200 crises, and really did a whole lot of economic research that I found absolutely fascinating. But they wrote a very interesting report and showed that most countries that have this very high debt to GDP ratio don't default on their debt. In fact, none of them did. None of the major countries did. The way they get out of the debt cycle is by a little bit of inflation. So just 6% inflation reduces a debt by half over a 15-year period. So all you need is just moderate levels of inflation and the debt is inflated away. So, the Fed has a hold back inflation goal, but the reality is inflation is what is going to be the tool to reduce the national debt when it becomes a problem. And no one's ever going to say this, right? But it's a reality of what's going to happen, which is why investors need to position themselves in what I've said for years. Position yourself to benefit from inflation because we are going to see inflation. And not only that, are we going to see it as the answer to the national debt at some point, we are seeing it now because of systemic issues like the structure of the employment market.
I want to dive into that a little bit more, but let me back up just kind of one question before. I mean, at this point, Bob, it seems clear like they're probably not going to increase rates, right? We're kind of on the cutting or stay still plan, you might say. So, as this is an investment show, we're an investment firm. Like, what does a rate cut mean for the public market traditionally and the private market?
Yeah, it typically influences the bond markets. Okay, so what a lot of investors don't realize is the Fed is changing the Fed funds rate, which is the shortest of short-term rates. Okay, the Fed does not control long-term rates. So those rates are controlled at auction. The Treasury issues bonds and bills, and they're auctioned. And the auction determines the pricing, which determines the yield. And so if there's a lot of demand for the debt, the yields drop. Right? Investors are willing to accept lower yields. You follow me? So it is an indirect relationship, but there is a correlation. So when the Fed drops rates, you will see the Treasury markets drop. And we've seen a lot of softness in the Treasury markets right now. The 10-year Treasury, which is really kind of the benchmark rate that a lot of commercial lending is based on, and even mortgages are loosely correlated with that. You've seen it very soft, and now it's right around 4%. So we're seeing that. Also, the Fed funds rate also, we're seeing the prime rate drop, which is the rate that banks loan to their best customers. So that's dropping. So we are seeing some easing, which is going to be a relief to some businesses and certainly to the real estate sector.
I did see the White House X account post the Trump effect that we have the lowest mortgage rates in the last 3 years of history. So I do think your earlier point of like, what is Trump's agenda? One, I think is clearly to show that the economy is healthy. And that's one of those tell signs of like, what is he promoting, right? It's interest rates and housing. I mean, a lot of their wealth for most people is in their house, of course. So I do think that's really interesting. I mean, in terms of allocation, are the markets going to have a tear? Are we in for a great run? Like what does this mean for investors and allocating, and maybe you personally?
And when you say the markets, are you referring to the stock market?
Let's start with the stock market, but then of course we're alternative investors, so I want to talk about both.
Well, okay. Anyone who's listened to me realizes I kind of have a bias against the stock market. Okay. So I'll just say that I've been burned by the stock market too many times in my life. Well, the stock market has had a historic run. We had two back-to-back nearly 25% gain years, okay, 2023 and 24. It is on fire. The chances that we have another one of those is virtually nil, okay? Now, it could happen, okay? But the reality is if you look at the valuation, which is the PE ratio of the stock market, where it is right now, meaning the price of the stocks relative to the earning potential of those stocks, right, the future earnings estimates, is as high as it has ever been.
Historic.
We're seeing the stock market very highly valued to perfection. And I'm personally wanting to increase my allocations in the public markets, but I don't want to do it at these valuations. The math would say that the returns on the stock market over the next 10 years should be around 0%. So roughly zero, between 0 and 1%. That's what the historical numbers would suggest. So I'm not hugely bullish on the stock market. And that said, how high can a tree grow? Can it go up from here? Absolutely. I've been shocked. I remember, the 90s, I think was it 95 or 94? I can't remember, 96, that Alan Greenspan called out the stock market at the dot-com, the irrational exuberance of the stock market. And I think it went up 3x from there, right? When he was talking about irrational exuberance. So irrational exuberance can be a lot more irrational, a lot more exuberant than we think. So it could definitely go up, but I don't think investors should be banking on another one big more run of the stock market. I think the downside risk is far greater than the upside risk. Although I don't see recession, so I don't see the risks out there. But of course, you never do.
Well, let's talk about a world that we spend more time in, which is real estate. I mean, talk a little more broadly about how interest rates are tied to assets and real estate and what you're excited about and what this might mean for this next couple of years of commercial real estate investing.
Real estate is very heavily affected by interest rates because, let's say, an apartment complex competes with a treasury bond, right, for yield. So you buy this apartment complex, you're expecting, a 5%, 6% yield perhaps. And so if you can get a 6% yield in a risk-free treasury, well, why bother buying an apartment complex, right, with all the headaches that go with that? So it definitely competes. So that'll drive cap rates. So what I would expect to see is cap rates begin to come down, and that will drive real estate values. So real estate is always levered using debt. And so the values are very heavily affected by debt. So I do think it's time to be investing in real estate, just because I think it's that time in the cycle. So at Aspen, we are having discussions right now on our partner level about really dipping the toe in and starting to buy a lot more multifamily. And I think it's a really good time to be buying really good deals. Now, it's not a time to buy anything, right? It's a time to buy at the right price. And there is a lot of ability to buy at the right price, right? There's a lot of deals out there that you can get at the right price because it's still a buyer's market for sure. And I think we're going to have a buyer's market for the next few years. So it's time to start accumulating these assets. From an investor's point of view, it's time to be positioning yourself for an inflationary reality, which is just what's going to happen. The structural reasons behind that are energy prices and the structure of the labor market. We have a structural labor shortage, and it's manifesting. I mean, right now you can see the inflation rate is roughly, let's say PCE is 2.6%, but wages are inflating about 3.6% per year. So wages are just increasing, and that's not stopping because we have a demographic issue. We're not seeing the pressure in the oil markets yet. I still think we're probably a couple of years away from that, and then that's going to continue to cause inflation to come about. Add the fact that ultimately the Treasury wants inflation to reduce the debt. Again, no one's going to talk about that, but the reality is, people know that.
What do you mean by we're not, just for clarity, we don't feel the pressure of oil prices yet?
Well, oil prices are quite soft. And it's really because the world economy has never really recovered. So the US economy is pretty strong, but the European economy is anemic. Chinese growth never resurfaced, right? And with the tariffs and, China under massive pressure, China's oil demand has never had a resurgence. So we're seeing global oil demand being continued to be very soft. So, we've been looking at oil investment globally, and it's very, very low, right? It's down by half from the last 7 years. So we're not seeing a lot of exploration development. And that's not a problem until there's a lot of oil demand. And right now we're not seeing a lot of oil demand. And we likely will not see an increase in oil demand in the immediate future, which is why I like investments. What we're doing is we're buying oil fields that make a lot of sense at today's low oil prices and will be insanely good when prices rise. And if they don't, we're still going to be fine, right? Because we're making money at these low rates.
That's kind of the same model for real estate, right? I mean, if you can make a deal work today,
Exactly.
where interest rates are at and where inflation is at, it probably is going to be really good over the next 3 to 4 years.
And it's actually a really good time to be buying oil fields as well, which is what we're doing. We're shopping, and as the oil strip, the future price of oil is coming down. Now it's, a year ago, we were buying with a strip, running $65, $70, the future price of oil. Right now it's $60. Well, that means we're getting these fields a lot cheaper. So, definitely time to be shopping.
The last thing I would say to that, from my perspective of being at Aspen, we did a multifamily deal this year, a great asset, but it was surprisingly very hard to raise for And what, we believe a really great time to buy real estate, compare that to 2 or 3 years ago, the money was really easy to raise and we saw where valuations went. I mean, it feels like, especially for sponsors, if there's sponsors listening now, I mean, it's a harder time to raise capital for real estate, at least for multifamily. But that can often mean it's probably a really good time to buy as well, right? Like that could be just another indication. Your thoughts on that?
Yeah, absolutely. Investors have the worst timing possible, right? It's well documented, and I studied the dot-com boom in my recent book, Invest Like a Billionaire. And in spite of the stock market racing up during the dot-com era, most investors lost money. In fact, the average investor lost 70% of their capital in the dot-com boom. Even though if you started at the beginning, wrote it all the way up and wrote it all the way down, you would have broke even. No one did that. People time it wrong. It just goes against human nature. To be a good investor, you must be contrarian. You must be fearful when others are greedy, and you got to be greedy when others are fearful. I mean, I've been in this business for decades. And so that's why the importance of this show, right? The importance of this show is to educate investors, to help them overcome their fear when it's time to invest, right? But I think it's okay to be fearful too. Like, I'm still out of the office market. I'm not interested in buying office space right now, right? So fear is a good thing, right? But I am also believe it's time for the multifamily market. So I'm not just all bullish all the time. We want to understand when it's time to invest and not catch a falling knife, but not wait until it's too late to place capital in front of these big trends.
100%. Well, let's wrap up here. Two things. One, kudos to you. This is the first time that we can announce live. You are a nationally recognized bestseller. The book has come out and, number 3 on the USA Today. Congratulations to you and Ben for hitting bestseller. Congrats.
Yeah, that feels pretty good.
Yeah, I actually wrote, I saw Ben write an email, and in the bio, we kind of put a winky face, best-selling author. So, it's something you can add in the future. Exciting announcement for listeners. We are also in the final draft of investlikeabillionaire.org. And I'm really looking forward to this because we've been wanting to build a place where our listeners can come in, collaborate, can chat with each other, can actually have live conversation about a lot of these topics. And so there's a wait list right now. If you're listening to this show, it's probably not up yet, but investlikeabillionaire.org. When we launch that website, you can be the first to know. So make sure you go check that out as well.
And what's it going to be for? What's going to be there, Ellis?
A lot of resources. One of the cool things that we're working on right now is kind of taking a little bit longer to roll out is, and Bob, I haven't even shown you kind of the product that I think we landed on, is we are actually going to create a live forum, a live community section where investors can actually create threads and go back and forth on resources and communities and deals and, hey, the Fed cut rates, what should I do, right? So I think that is going to be a very, very meaningful thing for our listeners.
Yeah, and the whole point is investor resources for alternative investments, finding the best deals, how to do due diligence, finding those best sponsors, everything related to alternatives, being a successful alts investor.
100%. Bob and Ben actually recorded a 9-part course that was exclusively for pre-orders of the book. We're going to be putting that up on the website as well for folks to be able to go through. So an actual course on how to become a professional alt investor. So really looking forward to that. Go to investlikeabillionaire.org and we'll let you know. All this is going to be free. So again, I really love being part of this mission, Bob, that you're on, really to bring alts to the masses, and so grateful to be on it with you. Anything else before we wrap up here today?
No, I think we hit it.
Awesome. See you next week, everybody. Cheers.